Good morning, friends. Today we'll be learning on the topic of asset classification and its provisioning. Now, in this topic, what is important is we need to understand that bank in their loan portfolio, which is mainly the various which is mainly the asset composition of a bank. Actually, these assets are classified into multiple categories, and these categorization is done based on the quality of asset. All assets means loans are not equally good. So some of them they are performing well, some of them may not be performing well, so they may be categorized into different segments under NPA, non-performing assets. So I'll see to it in detail in this particular slide. Along with NPA categorization, we'll be going into provisioning norms also, and we'll understand how banks are making their provisions for their doubtful cases of loans. So one more thing which is very important we should understand before we go into this topic is banks in order to have sustainability needs to be having efficient provisioning, and provisioning is only possible when banks do have their profits. So if banks are performing well in terms of profits, they'll be able to have their effective and sufficient amount of provisioning, which will keep them sustainable. Now, carrying on with this, we go into the first slide, where in this particular slide, bank advances are classified into two segments. First is performing and second is non-performing assets. And you see, in non-performing means any asset which is kept on a default for a continuous period of 90 days. Now, what is important here to notice, you should have a default of 90 days without any break. Means it should be a continuous 3 months of default in terms of principal as well as interest repayment. Now, this NPA segment is classified into three categories, stating to be substandard, doubtful, and loss. So these are sub classification of NPA. Now you go further, we'll try to understand certain examples of NPA. So this slide will give you certain better idea on how a particular case of loan can go into NPA. So first segment is where you do have a loan, and any normal loan, maybe a term loan, consumption loan, or production loan, any type of loan that you have studied in previous slides is is on a default, and this default period is greater than 90 days. So up to 90, no problem. But if it is less than 90, you cannot term them as a default account. But if it is this default period is greater than 90, then you can term them into NPA category. Now this is first segment. Now second segment is where you're dealing with overdraft and CC limit. Now overdraft and CC limit is where you're dealing with some sort of business account where the people are borrowing it on the basis of stock and book debt. Book debt means they are into their business where they are dealing with certain debtors to whom they are selling on credit. So based on these debtor values and stock kept in their warehouse, their people are having certain limits with banks. So in such cases, if this installment, which is supposed to be see every month, and the people have to see how much amount of outstanding value is there, and then interest is computed accordingly. So if these overdue accounts are not repaid continuously for a period of 90 days, then it will also go into same NPA category. Now next is bills. Now under bills, you do have your usual bill don't have any problem, but when banks are especially in certain cases required to go for financing bills by discounting them for their good clients, and this bill discounting may also lead into take a bank into risk, that is NPA. Now if any bill which is discounted is not encashed within a period of less than 90 days, then it is supposed to be a NPA. So all discounting of bills, and usually try to understand, usual tenure of a bill is 30 days, 60 days, or 90 days. So 90 day is max period. So if any bill is issued by a client to by one of our customers client to our customer, we can discount that bill and we will be earning a commission on it. But this is actually a type of loan exposure, whereby if customer has been paid in advance, so on maturity date bank will be getting this realization into their pocket. So if this realization on due date is not happening and it is again delayed for more than 90 days, then again it will be coming into NPA category. Now next segment is like agriculture loans. You see, in India 70% of your population is into agriculture. Now under this segment, again I tell you that you have two sub classifications. One is like you do have short-term crops. Short-term crops means with the crop season of approx 6 months. So they'll take 6 months to have their harvest. So, and then you do have second classification, which is long-term crops, where it can be for 1 year or so. So in both these cases, the definition of NPA is based on crop seasons. So in short-term crops, you will have waiver for 2 crop season, that is like 6 months into 2, so approx 12 months waiting period will be there. And then in case of long-term crop, you have to wait for 1 crop season, which is like 12 months. So bank has to, whenever they are having a default for more than 12 months from a farmer who is into a long-term crop sowing process, so they have to declare it after 12 months. Now this NPA declaration in agriculture is very difficult process, because in agriculture everything is dependent on monsoon. So if monsoon is good, everything is good, but if monsoon is not good, then you have to go for some special packages and exemptions for farmer. Now this is one major reason where farmers, when are unable to pay their debts, they are committing suicide. Is a major concern. Government has come up many a times where they have given bailout packages to farmers. So that is related to this segment. Now next is you do have securitization transactions also. Now securitization transactions are usually meant for investors. Now in this case, what is happening is bank may also be an investor in any of your securitization process, where they have put up some of their investments. Now in such a case, if your investment is not giving you return for a continuous period of 90 days, means you're not able to get your fixed or whatever variable returns you are getting from this type of structured product for a continuous period of 90 days, then you have to declare it as an NPA. Now these are certain examples of NPA, and then now we'll go into the further categorization, how these NPAs and these types of sub categorization of NPA are considered risky. Now you see, and how they are classified according to timeline. Now substandard assets is the first category, followed by doubtful, and the last category is loss. So you see, the moment I'm going downwards from 1 to 2 and then from 2 to 3, what is happening is my quality of asset is going down. Now these are classified based on their timeline. So any asset which has been into a default mode for more than 90 days will be termed as a substandard asset, or it is termed as an NPA. In NPA, first category is substandard. So default more than 90 days and less than 12 months will be considered under this category. So in this segment also, whatever loan amount will be there, you see, you'll have 2 segments under it. One is secured portion and one is unsecured portion. Secured portion is the portion for which you do have your collateral available to you, and unsecured portion is the amount of loan for which you don't have any collateral available to you. Now second segment is doubtful asset category. In doubtful asset category, you see, this is the same asset which was earlier lying into substandard category. Now substandard category, this asset was kept for less than 12 months. The moment it is touching 12 and more, this asset quality goes down. It is getting eroded, and further what will happen is the asset will be downgraded from substandard to doubtful category. And this will again have 2 segments of secured and unsecured. Now secured means you do have collateral value which is sufficient to cover your loan outstanding value, so here you don't have any risk. But unsecured is where your collateral value may not be there, or it is less as compared to actual loan outstanding, or the quality of your collateral is falling down. So these are the reasons where you may be running into risk. And then last category is you do have your loss assets. Loss asset means anything which is greater than or equal to 12 months. Now any asset which is into doubtful category, the definition is saying like it should be greater than 12 months. Again, now you see, once it goes into doubtful category, there it will be staying for some period of time. Now time is not defined, it depends on bank's discretion how they are recognizing their doubtful assets into loss asset. Now it is all depending on to the bank and the auditors who are involved in the processing. Now, the moment bank realizing the fact that like they are unable to recover this loan amount, then they have to transfer it into loss asset. Now, once a asset is transferred into loss asset, the only like remedy available to a bank is like they have to write off this asset from their balance sheet using their provisions. Now, you go further. Now here in this particular slide, here after we'll be learning about the rates which are applicable on different types of asset when it comes to provisioning. Now you have to go for provisioning at a particular percentage. Now category of advance. First is standard assets. Under standard asset, you see you have three classifications done. First is advances to agriculture sector and small and medium enterprise. So these two segments, if you are giving loan and those loans are repaid on time, that means they are standard asset in nature. So for all such amount or whatever portfolio value is assigned to this particular segment, you need to keep a provision of 0.25% of it. Now this is just a precautionary one. And then you go to the second segment, which is considered to be a little bit risky. It includes commercial real estate. So any property builder and all, any exposure to such segments, we will be coming into this sector. So here we are trying to be a little bit more conservative by putting a provisioning percentage of 1%. Earlier it was 0.25, now it is 1, means we are taking it 4 times more riskier to go into this sector. And then whatever loans in this is the third category. Now whatever loans which are neither covered in the first and second segment will be having a provision of 0.4%. 0.4% means they are supposed to be provisions to the tune of 0.4% of the total value of the loan portfolio. This is under standard asset category. Now see, standard asset category means we do have a risk that these assets may be in future going into a risky zone or their quality may be eroding. So what we are doing is like this is a type of provision or this is a type of precautionary measure on the part of bank where they are building up certain provisions out of their profits just to cover up their future risk. Now you go to the second sheet. In this, what we are doing is like we are trying to understand the classification of assets into NPA category and their required provisioning. Now you see, under substandard category, you do have 3 types of sub assets, starting from secured asset to unsecured exposure, and then to like unsecured exposure, especially into infrastructure sector. Now substandard assets quoted here are to be provisioned at 15%, 25% and 20% respectively. Now then you go to the second segment, which is doubtful, where again you do have 2 segments. In doubtful category, you have secured portion and you do have unsecured portion. So unsecured portion means here you don't have any chance of recovery. So there you will be making 100% provision. So it is underlined and is given 100% weight. Whereas if it is a secured loan, then you need to understand that what is the timeline since when this asset has gone into doubtful. Is it less than 1 year? Is it between 1 to 3 years, or is it greater than 3 years? So in all these 3 segments, what we are supposed to do is like we have to keep a provision of 25%, 40% and 100% respectively. So anything which is greater than 3 years is considered equivalent to loss. So will be given 100% weightage. Means the more and more you go down into your grading, and it indicates that you have to go for higher and higher amount of provisioning. And finally, loss assets or loss advances are to be kept provisioned for 100%. Now this is all about provisioning. Now I'll show you a summary sheet. This is actually the summary sheet. Now this summary sheet is telling you about whatever percentages you need to remember. So this is what is supposed to be memorized before you go for any exam. Now you see, this is PCA, stands for your provision coverage ratio. Now this is the total amount of provisions that are available with the bank divided by gross non-performing asset. Now you see, if provisions are sufficient in comparison to your gross NPA value, then it is good. Higher the value is better for the bank. But chances are very rare that banks will be having sufficient amount of provisions. It is only because of the fact that like loans are growing at a very fast rate. so leading to heavy accumulation of NPA. But when it comes to profit, banks are not, due to competition and pressure into banking, banks are not able to generate good amount of profit. So one side profits are falling down, second side your gross NPA values are going up very fast. So rarely you'll find banks with a good PCR ratio. Now you see, we'll be taking up two case studies. Now this is to be done by student themselves. First case study is like where you have to compute. There is a firm named as ABC Limited. It is a non-SME company. You need to create provisioning taking the P&L which is given to you as follows. Now the bank has following assets under their like balance sheet. Now what you need to do is like you need to summarize how you will be getting your total amount of provision out of this picture. Now you see, you need to use this type of sheet for computation, where you are requiring your classification of asset on one side, then you should have your amount of advance given to that particular segment, and then according to the rate chart we need to put up percentage of provision required, and then we have to compute the provision. So if you go by the rules, you'll have this computation. Means in this case a total provision of like 9,080 rupees required under various sub dimensions. Now in this everything is given in detail. You do it of your own and try to understand how things will be working out. So similarly we'll go to second case study. Now in this case study also again you have been given information and you are required to compute the provisions which is required for Hyderabad Bank. Now in this you do have loan value and you have been given like certain securities side by side, so which is giving you a concept or an idea about like the total loan amount and what amount of loan is actually secured or it is not secured. So accordingly you have to go for provisioning. Again you have to go and follow the same rule. First is like you need to prepare the sheet. Yes, this sheet will make it easy, and then followed by your final computation, which is like you see standard assets, you do have substandard assets, you do have doubtful assets, and you do have loss assets. In this case you don't have any loss asset, so similarly so you have further sub classification under various categories. So accordingly in this given case, based on the loan portfolio which they have, a total provision of 1,723 is required. Now this needs to be computed separately for different types of loan accounts and then added together. So this is like all about this session. Thank you, and I feel like you are able to understand what we discussed in this slide.